For decades, one country has played a central role in shaping the global economy. From the smartphones in our pockets to the clothes we wear, a huge part of the world's production depends on China. But what if this economic giant begins to slow down? What happens if China's economy, once growing at nearly double-digit rates, loses momentum for years, not months? Would this be just a domestic issue, or could it trigger global consequences affecting jobs, prices, markets, and even geopolitics? In this video, we'll explore what happens if China's economy slows down, why it matters to everyone, and how the ripple effects could reshape the global economic order. Why China matters to the world. China is not just another large economy. It is the world's second largest economy, the largest manufacturing nation, a key trading partner for more than 120 countries for decades. China has been responsible for a major share of global growth. When China expands rapidly, factories around the world stay busy, commodity prices rise, and international trade flourishes. But when China slows, the opposite can happen. Because China sits at the center of global supply chains, any weakness in its economy quickly spreads beyond its borders. Why China's economy could slow down. China's slowdown is not caused by a single factor. Instead, it is the result of several long-term structural challenges. Demographic decline. China's population is aging rapidly. Fewer young workers entering the labor force, productivity growth becomes harder to maintain. A shrinking workforce means lower consumption and higher social costs. The property sector crisis. Real estate has long been a pillar of China's growth. Housing and related industries account for a massive share of economic activity. But falling home prices, unfinished projects, and debt-laden developers have weakened consumer confidence. For many Chinese families, property represents their largest asset. When property values fall, people feel poor and they spend less. Rising debt levels. China's local governments and corporations have accumulated significant debt. High debt limits future investment and increases financial risks, especially during economic downturns. Slower global demand. As growth weakens in the United States and the European Union, demand for Chinese exports slows as well. Geopolitical and trade tensions. Trade restrictions, technology bans, and supply chain realignments have reduced China's access to advanced technologies and certain export markets, adding pressure to its growth model. What happens inside China? A prolonged slowdown would have serious domestic consequences. Rising unemployment. Manufacturing, construction, and technology sectors would face layoffs. Youth unemployment, already a major concern, could rise further, increasing social pressure. Weaker consumer spending. When wages grow more slowly and household wealth declines, people save more and spend less. This creates a vicious cycle, slowing the economy even further. Local government stress. Local governments depend heavily on land sales. A weak property market reduces their income, forcing spending cuts or higher borrowing. Government response. Beijing would likely respond with infrastructure spending. Easier credit conditions. Support for strategic industries. However, excessive stimulus could worsen debt problems, making long-term reforms harder. Impact on global trade. China is one of the world's largest importers of raw materials and intermediate goods. If its economy slows, imports decline, global trade volumes weaken. Export-driven economies feel the strain. Countries that rely heavily on selling goods to China would experience slower growth and weaker currencies. Commodity markets feel the shock. China consumes more than half of the world's iron ore and copper and is a major buyer of oil and coal. A slowdown would likely lead to lower commodity prices, reduced investment in mining and energy, job losses in commodity exporting countries, while lower prices benefit importing nations by reducing inflation. Exporters like Australia, Brazil, and many African countries would suffer. Financial markets and investor stock markets. Global stock markets often react sharply to signs of weakness in China. Sectors most affected include emerging markets, luxury brands, Industrial and commodity-linked companies' currency markets. A weaker Chinese economy could put pressure on the yuan, affecting global currency flows and increasing volatility. Investor confidence. China has long been seen as a stable source of global growth. A prolonged slowdown could reduce investor confidence worldwide. Impact on developing countries. Many developing countries depend heavily on China for export demand, infrastructure investment, financial support. A slowdown in China could lead to lower export revenues, project delays, higher debt stress. This could increase financial instability in vulnerable economies. The United States and Europe. For advanced economies, the effects would be mixed. In the United States, companies exposed to Chinese consumers would see weaker profits. Agricultural and technology exports could decline in Europe. Manufacturing-heavy economies, especially Germany, could feel reduced export demand. Luxury brands may see falling sales, however. Lower global inflation from cheaper commodities could give central banks more flexibility to cut interest rates. Geopolitical consequences. Economic slowdowns often reshape global power dynamics. China may focus more on domestic stability, reduce overseas investments, become more cautious in international projects. Global institutions, such as the International Monetary Fund, may face increased pressure as spillover effects hit emerging markets. Is a slower China necessarily a disaster? Not always. A slower but more balanced Chinese economy could reduce global inflation, encourage supply chain diversification, lead to more sustainable global growth for China. Slower growth may shift the focus toward innovation, productivity, higher quality consumption. The real risk lies not in slower growth itself, but in a sudden and disorderly slowdown. If China's economy slows down, the impact will not stay within its borders. From commodity markets and global trade to financial systems and geopolitics, the effects would be felt worldwide. China's economic future is one of the most important variables in the global system. How smoothly it manages this transition may define the next chapter of the world economy.